Thinking about buying a home? Well, these are the steps that you'll be going through during the process. First off is deciding whether you're actually ready to buy a home. Purchasing a home is a huge commitment, and you'll want to know if you're ready to be a homeowner before you go house hunting. Here are some factors that you and your lender should consider. Besides looking at how much income you bring in, your lender will want to see your W-2s and your pay stubs. And if you're self-employed, they'll want to see your tax returns and other pertinent documents. Another source that your lender looks at is your debt-to-income ratio, also known as DTI. They'll want to see the amount of a mortgage that you can take on after looking at how much of your income goes to paying off your debt every month. DTI is calculated by dividing your monthly debt by your gross monthly income. For example, if your monthly debt is $2,000 and your gross monthly income is $6,000, then your DTI is 33%. The debt shown on your credit report is what your lender will use to calculate your DTI. It's best to review your DTI before you apply for a loan. Every lender varies, but most lenders are looking for a DTI of about 43% or lower. Next is liquid assets. Most of the time, you will need liquid assets to help fund your loan. There are some instances where borrowers can buy a home without no money down, but the majority of homeowners would need cash for a down payment. And the first big payment will be your down payment at the close of escrow. Your down payment depends on what kind of loan you're acquiring and how much money you're borrowing. Also, you would need liquid assets to help pay for your closing costs. Closing costs are fees that your lender and other third parties charge you for helping you to obtain the loan. Next is your credit score. Credit score plays a big part on what kind of loans and rates you're able to get. And it tells lenders how much of a risk you are when providing you with a loan. Making the necessary steps to reducing your debt will improve your credit score and help you obtain a better loan with lower interest rates. When you feel like you're ready to buy, it's good to go over your numbers. A good place to start is to check your DTI. Look at your debt, your income, and how much you feel that you can reasonably spend per month on your mortgage. Things to consider when owning a home is property taxes, home insurance, and maintenance. So make sure you calculate that into your monthly budget as well. Next is to start saving for your down payment and closing costs. You can see for yourself using your savings or through investments. Another option is to seek help from family members who are willing to help contribute money towards your down payment. If that is the case, you would need a gift letter to submit to the lender. Your down payment is a one-time large payment towards your mortgage. Most lenders require this because it helps alleviate any loss in the event the borrower defaults on their mortgage. A lot of homeowners think that they would need at least 20% down for their mortgage, but this is necessarily true, and that many borrowers are not able to save that large of amount. There are instances where conventional loans that only require 3% down. There are FHA loans that home buyers can utilize for as low as 3.5% as well. Department of Veterans Affairs, also known as VA, and United States Department of Agriculture, also known as USDA, loans even qualify borrowers to put 0% down. But the advantage to putting a down payment of 20% or larger is that you would have a lower monthly payment, and you would also not have to pay private mortgage insurance, also known as PMI. You will also need to save money for your closing costs. These are fees that your lender and other third parties charge you to obtain a loan. Closing costs are typically 2 to 5% of your loan amount, with a smaller percentage for larger loans. For example, say you're purchasing a home for $500,000. You'll likely be closer to $10,000 at 2%. When you're ready to start looking for homes, it's time to get pre-approved for a mortgage. When you apply, your lender will give you a pre-approval letter that states how much you're pre-approved for based on your credit, assets, and income. You'll provide a pre-approval letter to your real estate agent so they can help you find homes within your price range. You need to apply with your lender to get pre-approved. The pre-approval process usually involves answering some questions about your income, your assets, and the home you want to buy. And a credit check will also be required. Next is finding the right real estate agent. Your real estate agent represents you in the home purchase transaction. Your agent will look out for your best interests by finding homes that meet your criteria, getting into showings, assist you in writing offers and negotiating. As a buyer, you typically work with the real estate agent for free, whereas a seller pays for the buyer's agent's commission. Real estate agents are local market experts that can advise you on how much to offer for each house so you can avoid overpaying. Now it's time to go house hunting. Your real estate agent will help you look for homes within your price range, and you'll want to put a list together of what your priorities are, such as certain neighborhoods, how many bedrooms, bathrooms, square footage, school districts, public transportation, property taxes, and so on. Once you get this list together, let your agent know and they'll help you accordingly. And when you're out there, make sure you see plenty of homes and don't worry if it takes some time. You want to make sure you find a home that you like and fits you the best. Once you find a home that you like, now it's time to make an offer. When you do decide to make an offer on a home, you must submit an offer letter in writing, or what we call a residential purchase agreement here in California. Your offer letter includes details about yourself, like your name, your current address, the price you're willing to pay for the home, and more. Most offers include an earnest money deposit, also known as an EMD. This is a small amount of money, typically 1 to 2% of the purchase price, but your real estate agent will be able to tell you what's common in your market. Your EMD goes towards your down payment and closing costs if you buy the home. From there, your agent will submit the offer to the seller's agent. The seller can respond in 1 of 3 ways. If the seller accepts the offer, you can move on to the next step. If the seller rejects your offer, you can choose to submit another offer or move on to another home. The seller can also come back with a counteroffer of their own. They may change the purchase price or the terms of the sale. You can accept the counteroffer, reject it, or make another counteroffer. The process of negotiations may take some time, but this is where your agent helps you manage negotiations. If you can't come to an agreement, then don't worry, there'll be other homes to look at. But if you do eventually come to an agreement on an offer, then the next step is the home inspection. I want to stress that you should never skip the home inspection. As beautiful as a house may look, or honest as the seller may seem, a home inspection may catch defects in the home that the seller would never know otherwise. For most people, this is the biggest purchase of their lives, so a few $100s is well worth a home inspection. Don't fret over small items such as a clogged drain or missing hardware. You will want to focus on major defects such as a shoddy roof, damaged foundation, or mold. After going over the home inspection with your real estate agent, you can request the seller to have any repairs done before the close of escrow. This can also be another negotiation between you and the seller, since they can agree, reject, or come back with a revised request of repairs, or simply give credit at closing. Of course, if something major comes up in the report, you can also reconsider the purchase of the home. Next is the final walkthrough. This is the time where you can check the home for any repairs done that the seller agreed to. It's also a time to see if the home was not damaged by the seller when moving items out, or if they left anything behind. The home should be completely cleared out for you. If everything looks good, then you can move on to closing escrow. You would then have to sign your loan documents and provide the funds for your down payment with the escrow company handling your transaction. The loan would then be funded and recorded, and you will then be handed the keys to your house by your agent. Congrats! Now you're a new homeowner. I hope this gave you an insight of what the home buying process looks like. If you have any questions at all, please feel free to reach out to me by commenting below, direct message me, text or call. I will be more than happy to help you further. Thanks for joining me, and I'll see you in the next one.